Hello, everyone. My name is Mayur Thaker. I'm an analyst and senior relationship manager here at Zacks Professional Services. And I just wanted to give a quick update on a couple of inflation gauges that I'm watching, as well as a quick reaction to the FOMC's December minutes that were just published last week, as well as discuss quickly two investment approaches that I think are going to be, working quite well over the next several months to, over the next 5 years. So let's take a quick look at some of these developments that we've witnessed over the past 1 week here. And just as a starting point, we can use the FOMC minutes. We were to just pull up the FOMC website and just read the minutes right here. The key takeaway from this was that the committee announced that they decided to reduce the monthly pace of its net asset purchases by 20 billion for Treasury securities and 10 billion for agency mortgage-backed securities. And so beginning in January, the committee will increase its holdings of Treasury securities by at least 40 billion per month. So that's down by 20 billion per month. And of agency mortgage-backed securities by at least 20 billion per month. So, the tapering has begun. And there's also a lot of discussion on the probability of the FOMC increasing interest rates in the coming months here as well. So that's what's moving markets today. We can see the markets have been down since the release of these minutes, and we see further weakness in the markets right now. So let's take a look at what exactly has been going on with regards to some of the key factors that's driving what the FOMC is thinking with regards to tapering the balance sheet in terms of the rate of asset purchases, as well as what their thinking is with regards to rate hikes in response to the inflation that we have been witnessing over the past several months. I always like to refer back to this one chart right here where we look at not just the CPI, which is what everyone is focused on, but also overlay that with the ISM manufacturing backlog index. And I think that's been kind of the key story here as to why we have been seeing such high inflation. We can see that backlog has been, essentially hitting and sitting at near 25-year highs. You can see that it's really never been higher, except for very brief moments, over the past 25 years. So this has been persistently high for some time. We hit an all-time high here. It has eased up a little bit here, but we'll see what happens, over the next couple of months here, where this backlog goes. But even right now, despite the fact that we've come off for the all-time highs here, we're still sitting at a very elevated level, which tells me that, demand is outpacing supply. Currently manufacturers are simply not able to fulfill orders at a rate that is satisfactory by those that are purchasing, these dry goods here and manufactured goods. So that's one of the reasons why I believe we have seen a CPI so high is, production woes, supply chain woes are still, a big time disruptor of production. And that's why, we're seeing high prices all throughout, different sectors of the economy, including autos, especially autos. But what's, important to also note here is, not just the fact that, demand is outstripping supply, but we want to make sure that the demand is strong nonetheless. Because remember, we could have falling demand and the backlog remains high if supply or production is falling at a greater rate than demand is falling. So we don't want to see that happening at all. So we shift over our attention to factory orders. And, we can see here that factory orders are actually quite strong. If we look at it on a nominal basis, we recaptured, the long-term trend growth trajectory of factory orders. But on a year-over-year basis, you can see that factory orders are growing at about 9% per year. Obviously, that's off a very high, watermark because we set a very, depressed level during the thick of the COVID recession. So the bounce back obviously was equally as impressive, but we can see that taper and moderate to more, appropriate comps. And we can still see that this rate of growth year over year is pretty much on the high end of what we have seen in the entire post-2008 Great Recession era. So factory orders remains very strong. This is what I've always loved to see because, if backlog is high, But backlog could be high if demand is falling at a slower rate than supply is falling. So that's obviously not a good thing at all to see. So to have a high backlog due to very high and robust demand, which is quantifiable by factory orders, that tells you that underlying the economy there is real demand. And most of this inflation story that we have seen thus far is production related, and that's what we'd like to see so far. Also, another thing that I'd like to note also is to understand what's happening with the price of gold. I personally believe that gold is the ultimate proxy for monetary inflation. And so that's why, many comparisons have been drawn to the picture that we are experiencing today with what we went through in the late 70s and other points in history as well, such as, the late 80s here. You can see that. But, I like to also look at the fact that, there's been a divergence between the CPI index and the price of gold. You can see gold has rebounded a little bit here in the past few weeks here, but not enough to really suggest that there's a trend reversal here. Whereas we saw in the late 70s, the CPI skyrocketed during that period of hyperinflation, but so did gold. You can see gold basically, tripled in that time period here, almost, gaining 179% since the beginning of the 70s decade. But today we don't see that at all, right? We see a very elevated CPI index, the highest that we have seen really since that late 70s, early 80s period. But gold is not following suit the way that we saw in the late 70s. So again, this tells me that the period that we're experiencing right now is a lot more comparable to that time that we had high CPI in the late 80s, early 90s. And that was, again, due to a supply disruption due to the first Gulf War period. We saw, a really big spike in the price of oil as that war broke out. So the CPI really had a big, surge. But at the same time, gold really did not do much at all. It really remained dormant that entire time period. So that, huge bout of inflation that we saw represented by the CPI was short-lived because ultimately, that Gulf War was resolved and prices then reverted back to, the long run average of, somewhere in that 2 to 4% range. So I think that's a similar thing that is what we're going to see here as well. I do think that the CPI will come down eventually. But as we saw in that late 80s period, we could have, several years of high CPI. And after which, finally, these bottlenecks will then, ultimately get resolved, one way or another, and have that CPI finally come back down. So when production finally catches up to demand, when production finally catches up to factory orders, we should see that backlog ease and therefore that CPI come down. And that's really what gold is really telling you right now, in my view. That's my personal interpretation of this chart, is that we really shouldn't see a high persistent, CPI for, a long time period, but we could see it for the next, 12 to 18 months, the way that we saw it here, where the CPI remained above 4%, beginning in 1987 and lasting all the way till, essentially 1991. So that was a 4-year period of high inflation there. But at the same time, gold remains subdued. So again, these are short-term or medium-term, production or supply disruptions that do ultimately get resolved. And I think that that's what we're going to see similarly here as well. As far as the labor market is concerned, though, we are seeing, truly unprecedented developments here. We see that, the total number of unemployed that we see in the upper panel here equates to about 7.3 million. And yet the total number of job vacancies is at over 10.5 million. So that means that we have nearly 3 million or over 3 million more job openings than the total number of unemployed. So that's a 20-year low that we have seen in terms of, 20-year high, if we were to use the spread between the total number of job openings and the total number of unemployed. So that really tells you that there's been a structural shift in the labor market where we saw record numbers of baby boomers retire during the COVID era. and those boomers are not being replaced quick enough by younger, workers in the economy. And we know that to be a fact because obviously baby boomers are such a large percentage of the population. We don't see enough millennials or Gen Z, kids joining the workforce at a similar rate. So that's one of the reasons why we see this happening. Other reasons could be because of unemployment benefits, or it could be also the wealth effect that's coming from the stock market. We saw, huge booms in, high, very, very high multiple stocks last year, as well as booms in cryptocurrencies. These are all factors that are contributing to, or at least discouraging, people from joining the workforce, thinking that they can just earn an income from trading in markets. And so that's another reason among many as to why this could be happening. So, due to a mix of all of the above, we are seeing record job openings that are just simply not getting filled quick enough here. And that is a phenomenon that could be one of the reasons why production has not been able to pick up. And so this is something that we should be monitoring very closely in the coming months here. We hope that this trend does not continue, but thus far it has. And that spread between total job openings and the total number of unemployed continues to hit new highs. And we're now at a 20 plus year high as we speak right now. So we'll have to watch that. Another thing that I'm watching very closely is interest rate spreads, and spreads have narrowed ever since the FOMC released these minutes last week. But they've been really narrowing for the past month and a half now, almost 2 months. We can see here that the 10s and 30s spread has really narrowed dramatically, really all year 2021, and that's continued thus far this year. Going from a spread of 80 basis points down to about 38 basis points. So this is concerning as well, because if we were to see persistently high inflation, then the bond market would be telling us this with higher yield spreads. But in fact, we're getting the exact opposite. We're seeing spreads tighten and getting back down here to points where, we were almost afraid of the yield curve inverting. That's, in contrast to what we saw during other periods of hyperinflation in the past 40 years, where, high CPI was coincided with not just high gold prices, but also very high yield spreads. But now we're seeing the exact opposite of that. So this is concerning as well, where the bond market could be telling us that, we could be headed for deflation with gold, remaining subdued, and now Treasury spreads are, actually tightening here. It's a tale of really two different worlds here, where the CPI is telling you one thing, but the markets are telling you another thing, and the bond markets are, some of the smartest. That's one of the smartest mechanisms that we have in financial markets, and that's telling us a completely different story here. So, deflation could be another thing to look out for now as well. So, these Treasury spreads are kind of concerning here. We can also see this with tips. Very interestingly enough, if you look at a 3-month chart of tips versus nominal Treasuries, here I have a chart of the IEF ETF, that's the iShares 7 to 10 year Treasury bond ETF, and the iShares TIPS ETF. And you can see that the two are basically moving in lockstep with one another over a 3-month period. So during this time where we saw, all-time highs in the CPI index, we see, the performance of TIPS essentially come in line with the performance of nominal Treasuries. If inflation were actually going to be here for a while, then TIPS should be outperforming nominal Treasuries by a long shot, and they're actually not. And so that's telling us that the bond market is sniffing something out here that isn't exactly what the CPI is really telling us. So this suggests to me that, there could be, risks of deflation that are actually coming forward here. And that could be caused by decelerating GDP growth. That could be caused by, a slowdown in earnings. So this is all, things to be very, very mindful of. And that's exactly these are the trends that I'm watching here. The factory orders is very, very, encouraging, but what the bond market is telling us is very discouraging from a market standpoint and from a GDP standpoint. So we will have to wait and see what happens, which one, ultimately triumphs. Is it the bond market that is the correct forward-looking indicator? Or are we going to see further strength in demand coming from factory orders, coming from ISM manufacturing, and other, gauges of economic growth? So we will see exactly which one ultimately prevails. But right now, the bond market is telling us that there could be a deceleration in growth, ahead. And that's one of the reasons why the stock market is now cooling off a bit here after rallying almost nonstop from, the COVID bottom.
So if I were reviewing my own portfolio as it relates to all of these factors that we've been talking about, these are the two options that I would consider.
One is the long-term, one is just maintaining a long time horizon and owning, high quality, high ROIC, high growth businesses that are experiencing secular growth and have, and are attacking a very large total addressable market. That's my personal investment approach. That's kind of what I have as the vast majority of my investment strategy. But also what's working right now is out of favor low multiple companies that are now in favor, right? And these are companies with quality balance sheets and earnings momentum as per the Zacks rank. So I have actually built a screen right here, which I can show you very quickly. I built a quick screen that looks for companies within the S&P 500 that are actually outperforming the S&P 500 over a 12-week and a 4-week period, have a strong Zacks rank of 1 or 2, which means that that's telling you that these are companies with strong earnings estimate revisions, strong earnings momentum, and also have quality earnings, meaning they have strong cash flow that's backing those earnings. So if I run this the screen right here, this will tell us that there's about 46 companies that pass the screen. And so these are that list of companies. Again, these are all companies that are performing well right now, showing relative strength versus the market. And many of these are very low multiple stocks, by the way. Some of them are deep cyclicals like CF Industries. These are basic materials companies. Some of them are industrial companies. Some of them are interest rate sensitive companies, such as financials or insurance companies. But, some of them are, long-term, secular growth companies. For example, one company that pops up on this list that I've, talked about in prior webinars is CBRE. This is, the world's largest real estate, management company, as well as real estate developer in the world. So this is a great list to kind of reference as well. So if you do want this screen, please do, email us at zrs@zacks.com, or if you are a, advisor tool client, please do email us at zat@zacks.com. So if you have any questions, or if you have need any further clarifications, or if you wanted the slide deck, I'd be happy to send that to you. Once again, my name is Mayur Thaker. I'm an analyst, senior relationship manager here at Zacks Professional Services. And with any questions or requests, please do email us at either of these two email addresses here, or call us at this number right here. So I hope that was helpful, everyone, and look forward to seeing you again on another Zacks Professional Services webinar. Thanks, everyone. Take care. Bye.